Hi, I'm Peter Andresen with Andresen and Associates. Good morning. I'm here to talk about what happened or what I think happened in 2022. It's my interpretation anyway. Thank you deeply for joining us. Now, this is interesting. It's information about what we think at Andresen and Associates, that's Eric and Karen and I, think happened in the financial markets in 2022. And I can't read minds. Nobody has a crystal ball. I kind of ignored the political stuff because you know what about that. I focused in this video on the financial markets. Different clients had different results because they went into the year with different risk parameters and different selections. So some clients had some results and some clients had others. Later videos are going to focus on what we think will happen in 2023. I have very strong opinions about that. And the other video that I'm going to do about 2022 is the lessons, because 2022 was the year that reality came back. The Federal Reserve couldn't manage things any longer. And that's a good thing. I think that's a marvelous thing. Financial markets can go way, way down. And my opinion is in no way a guarantee of investment success, although I have to say we've done relatively well. Investing is always a blundering process, and I want to tell you, we don't really ever really know what's going to happen. So expect chaos. That's part of the way this whole thing operates. This is the big news. The big news to me is that this was the worst bond market year in modern history. Amazing. And that flowed over into the 60-40 portfolio allocation. That's 60% stocks, 40% bonds. That's kind of the traditional safe conservative mix. And it was the third time since 1926 that they had such a negative result. It was very hard, down about 15%. We at Andresen and Associates, as you know, got conservative a few years ago, one would say early. And as a result, we had relatively good results comparatively. We lost money in most portfolios, but we didn't lose in most portfolios in any kind of catastrophic way. The good news of this is that historically, when this happens, the next year, and the average is a positive 17%. So we'll see, but all hope is still with us. Now, we've been in the process, I call it the big change. It's all very experimental. That the Federal Reserve and the government have been experimenting with the economy. And 2022 is the year that we started to see some results. We've basically had a decade or more of extreme fluctuations in interest rates and money supplies. And we're finding out that, guess what? If you stimulate the money supply, after all, just like classic theory, you end up with inflation. So check out that black line over on the far right. That's the money supply spiking during the pandemic. I mean, they poured money on this thing. Politicians raced to see how much helicopter money they could deliver. And the result was substantial historic inflation. It peaked at 9.06% year over year in June. And then it's reversing right now. Remember, reversing does not mean a soft landing. Reversing means it may go, inflation may decline, and we might push through to a recession. We don't know. But the big thing is, look at that money supply going way up and going way down. So chaos again. And those people are allegedly the smartest people in the room. So, okay. From one extreme to the other, the Federal Reserve sharply raised interest rates in 2022 to combat inflation. And this was good news to me because these zero interest rate policies of the past decade have created a bond mountain that we're going to have to work our way through in the coming decade, created all kinds of pernicious consequences, among them overinvestment into the stock market. People gave up on CDs and treasuries. And guess what? You can now own a one-year treasury that has a yield. So the bond market is back. Basically, all the savers got sacrificed by the Federal Reserve to prop up the financial system, and now it's back. But look at that over on the far right. Look at that astonishing rise in interest rates off the bottom from zero. And remember, we had negative interest rates in places like Europe and Japan, which was insane. And we're going to have to deal with those consequences in coming years. The result was that bond markets had their worst year ever, for real. The good news is that we at Andreessen and Associates realized years ago that this might happen. So we moved to shorter maturity bond mutual funds. And if we wanted to hold long maturity bonds, we let asset allocation funds handle that. The ones we held were the asset allocation funds only dropped about 9% because of their energy holdings. So we succeeded. We did experience declines, but they were not usually so catastrophic. If you look at TLT, that's long-term treasuries, it was down 30% for the year. Absolutely amazing. The stock market is in yellow or gold or whatever that is. Basically, the S&P 500 was down 18%. The Schwab bond index fund was down about 14%. Now, it's almost unheard of. In fact, it is unheard of to see long bonds give you a worse year than the stock market. So, historic year. The stock markets declined as well in response to those rising interest rates. We had, in past years, we had tilted our portfolios away from equities a little bit, and especially we were getting out of we kept some, but we didn't really have large amounts in highly valued tech. So most of us in our portfolios lost money, but not as extremely as the indices. Our allocations to energy, which we made back in 2020, that slide is incorrect. We bought energy back in 2020 when it was sucking air because of the pandemic, and it really paid off in 2022. And we also allocated into value funds, stodgy cement factories. So look at the black line. That is Oxier Focus Fund. That's our boring value fund, down about half what the S&P 500 did. That rust or red line is ARKK. That's extreme tech, down 70%. Although you could say Tesla and some of the other big tech companies were down over 50%. Tech got slammed. So, and the blue is energy. That's our Vanguard Energy Index Fund. Most of us had something other than that because of transaction fees, but still mostly up. Healthcare also did well, relatively speaking. So we lost money, but we didn't lose as much money as the indices did. And tech, if this keeps up, is going to be a bargain. In the middle of the year, the dollar rose with the interest rate versus other currencies. So we began to grow our allocation into international holdings. We're not done yet. We kept moving money from domestic bonds and from domestic equities into international. Our international asset allocation funds like First Eagle, as they did back in the first decade of the 21st century, came through really nicely. They lost less than the S&P 500 index again. That's because they tend to hold commodities, which did really well in this inflationary cycle. China in 2022 went way down and then came roaring back up. But we're not in it mostly because I am concerned that historical trends are saying that China and Russia are like Germany and Japan in the 1930s, and there's a fight ahead. That isn't a sure thing. It's just what history seems to be whispering to us. So once again, our internationals, we're growing those. I still think they're relatively attractive. Emerging markets got hit worse. They tend to track China. They got hit worse and they came back stronger. So let's see what happens next, but I still like internationals. To recap, the good news, and this is big, reality returned. It's gigantic. Now it's like we know where we are on the map. For a couple of years there, I wasn't so sure. Inflation is up. Surprise, surprise. Guess what? If you pour money on it, it's like pouring gasoline on a lit fire. Something's going to happen. Interest rates went up. And so we went from one extreme, which was zero and negative interest rates, all the way to historically normal interest rates. We didn't go to extremely high interest rates. These aren't high, they're historically normal. The result was that bond markets dropped like rocks. We're not used to that. Remember, in a recession, which may or may not happen in 2023, interest rates tend to go down. So the stock market will go down as well, but bonds should be self-healing. That's not why I'm really worried too much about that. So stock markets are going to be down. They're going to, they will be down if we have a recession because earnings have yet to fall. We still have record high corporate profits. So stock markets fell in 2022. They could easily fall a little bit more in 2023. Because we expected some sort of turbulence, most of us experienced below index portfolio losses. So all in all, I have to say, when I look at your portfolios, I'm pretty happy. Call me if you have a differing opinion. Some things to keep in mind. We are back on the map. We know where we are. And the map says, historically anyway, that positive times will eventually return. And it's great to see the financial markets behaving with some degree of historical normality without being totally dominated by the Fed stimulus. What happens next? I'm going to do another video very soon about that. It's the subject of my next video. A recession may or may not happen. Historically, it will happen. All these statistics are lining up to say it'll happen, but that doesn't mean it really will. I'm not pushing to buy now because if earnings decline with a recession, that means the stock market is likely to decline more. But I will be buying. We're going to have to get in there and buy some of these bargains. And it's going to be scary and ugly. We may or may not have seen the stock market's low. If we did see the low in 2022, we have to play some catch up. But if history, I wouldn't say repeats itself, but if history rhymes like it normally does, we have not seen the stock market's low. And we won't know it when it occurs. So all I'm looking for is decent valuations. And I want to emphasize, we don't really know what will happen. Building long-term success requires time, discipline, and consistency. So invest now. It's historically likely to create lasting value in 5 years and beyond. Most of us will want to buy as bargains evolve, but we don't want to rush this. Patience also pays off.